Hi everyone, my name is Hilia Elu and I'm the Head of Research and Innovation at Foster Digital Education. I'd like to welcome you to the final video in our share giveaway competition series. Over the last 2 weeks, we explained MTC's IPO in detail and how you can apply for MTC shares step by step. The response has been nothing short of incredible, with so many Namibians coming out and showing an interest in becoming shareholders. But even in excitement, it's important to not get carried away. In this video, we look at the pros and the cons of investing in equities such as MTC. The first thing that we need to clarify is that investing in stocks such as MTC is not a get-rich-quick scheme. There are two ways in which investors make their returns from equity investing. These are 1. Dividends, which are the payments made by companies to their shareholders, usually from the profits of those companies. And 2. Capital gains, which is the value derived by an investor when the price of their shares goes up. For example, if the MTC share price increases after the IPO, and a shareholder sells their shares for more than they purchased it for, they will have made capital gains. The first major concern when investing in equities is the level of risk involved. Dividends are usually paid from company profits, which means they rely heavily on how well a company is performing. If a company is going through a difficult time, such as what happened to a lot of companies when COVID-19 struck, that affects the company's profits and ability to pay shareholders a dividend. Also, companies technically don't have to pay dividends to shareholders. The decision to declare dividends rests in the hands of a company's board of directors and not its shareholders. So, shareholders don't have a say in, if, and when they receive dividend payments. In the case of MTC, their prospectus has forecasted that they will be declaring a dividend of 63 cents per share for the 2021-2022 financial year. With capital gains, the price of publicly traded shares is determined by what the market, which is other investors, think about those shares. If they believe the company is going to do well in the future, they'll make offers to buy into it today, which will drive the price of the share upwards. If the existing investors in the company think it will perform poorly in the future, they'll try to sell their shares today, which will drive the share price downwards. So, it's important to consider a company's future before investing in it, because the price of the shares could drop drastically and you'd lose your money. Capital gains also introduce another important consideration when investing in equities, which is the concept of liquidity. Liquidity refers to how quickly an asset can be converted into cash. In terms of shares, this is how quickly they can be sold to other investors. Your ability to sell your shares depends on whether there are other investors looking to buy those shares at the price you are selling them for. The Namibian Stock Exchange, on which MTC will be listed, is not as large as some of the other stock exchanges globally and does not have as many participants in the market. This means that selling your shares may take some time if there isn't any demand for them at the time you're trying to sell. So, equities are generally riskier than assets such as bonds or deposits into a bank account, but they usually present the opportunity for higher returns to compensate for that risk. And that's it. Thank you guys so much for tuning into this series. It was the first of its kind for us, but it's definitely not the last. So, subscribe to our YouTube channel and follow our social media pages for more exciting projects which are definitely on the way. And remember, learn, connect, grow.